Imagine it's June 2026. The stock market opens, and the tech sector, the engine of the global economy, suddenly fractures. Within days, hundreds of billions of dollars in market value evaporate. In the middle of this chaos, Apple takes a step it has avoided for decades. Without announcing a single new product, they drastically raise the prices on their existing hardware, right in the middle of the calendar year. The broader market follows suit. Giant tech companies suffer immediate, double-digit drops, pulling the entire NASDAQ down with them. This fallout validates months of warnings from major financial figures, who have pointed to this as a textbook example of an industrial bubble. The underlying cause of a crash like this is simple. The tech industry has run headfirst into an inescapable, catastrophic math problem. To understand that math, we have to look at what Amazon, Meta, Google, and Microsoft are doing right now. They are currently locked in a spending spree unlike anything we have seen in modern corporate history. This flowchart illustrates a highly revealing projection from recent financial reports. For every single dollar of operating cash flow big tech generates, they are expected to spend 94 cents directly on building out artificial intelligence infrastructure. That leaves exactly 6 cents out of every dollar to dollar everything else. Employee salaries, stock buybacks, dividends, and research into entirely new products all have to be squeezed into that tiny remainder. These companies are taking nearly all of their money and betting it on a single assumption, that humanity will eventually pay a massive premium to use all of this computing power. When we talk about the cloud or AI infrastructure, we're really talking about these. These are data centers, massive windowless industrial warehouses that can easily cost upwards of $25 billion apiece to construct. The cost isn't in the concrete, it's inside the server racks. A single warehouse holds up to 100,000 specialized graphics processing units, and each one of these individual chips can run $30,000 to $40,000. This insatiable demand for hardware is warping the global supply chain. Memory chip manufacturers like Samsung are taking the capacity they used to dedicate to laptops and phones and redirecting it almost entirely to AI components because data centers pay 10 times more. Because the hardware supply is being hoarded for artificial intelligence, the cost of the memory chips going into everyday consumer electronics is spiking. You end up paying an invisible AI tax on your next laptop or smartphone. This chart shows the capital expenditure of the 4 biggest tech giants. In 2020, they spent a combined $90 billion. By 2026, that number is projected to hit $725 billion. They have to spend this money. The sheer volume of data being generated globally is growing exponentially, forcing tech giants to physically build out this capacity, whether they want to or not. But eventually, the bill comes due. If you are a serious investor putting money into a risky, capital-intensive project, you generally demand at least a 10% return to justify the risk. Based on massive infrastructure costs, analysts calculated the AI industry needs to bring in $650 billion every year. But the actual current revenue of the biggest players combined is only around $75 billion. The reason for this massive shortfall comes down to the enterprise software market. The original business model assumed large corporations would pay hefty subscription fees to integrate AI into their daily workflows. But those companies are finding it incredibly difficult to actually get a return on that investment. The data bears this out. MIT researchers found a 95% failure rate in achieving measurable financial returns from AI tools, and McKinsey reports that nearly 3/4 of enterprise deployments are failing to meet their projections. Corporate executives are frustrated. They are paying enormous fees for AI tokens that aren't actually improving their bottom line, so they are actively beginning to switch their traffic over to much cheaper offshore models. That is the core of the problem. The industry is currently spending roughly $10 for every single dollar it brings in, and its most important customers are desperately trying to figure out how to stop paying. Why would the most successful companies in the world continue to pour billions into an equation that looks so heavily flawed? Economics gives us a framework for this. It's called the capital cycle. We actually have a direct historical blueprint for what is happening right now. You just have to rewind to the late 90s, during the boom of the internet and telecom industries. Back then, telecom companies believed internet traffic would double every few months forever. They spent $500 billion laying fiber optic cables across the country, but demand didn't grow nearly fast enough, leaving 95% of that cable unused, triggering historic corporate bankruptcies. But here is the interesting part. Those fiber optic cables didn't disappear when the companies failed. They stayed in the ground. Years later, when the world actually was ready for streaming video and cloud storage, that discarded, dirt-cheap cable became the physical backbone of the modern internet. The technology was completely real, and the internet did change the economy. But the telecom companies' assumptions about pricing and timelines were completely disconnected from reality, leaving them with massive, expensive capacity that nobody was ready to buy. If we apply that history to the current AI market, we are looking at two highly distinct outcomes. Path 1 is that the bubble pops, the stock market corrects, big tech slams the brakes on spending, and the resulting shockwave wipes out tens of thousands of jobs across the global IT sector. Path 2 is that the bubble doesn't pop. Instead, the tech giants refuse to take the loss and ruthlessly force their way to profitability by heavily increasing the cost of AI tokens. In that scenario, the cheap, highly accessible AI tools you use to write emails or generate code today disappear. They become gated, unaffordable luxury products that only megacorporations can afford to run. None of this means artificial intelligence is fake. The capabilities of these models are genuinely astonishing, and they will likely rewire major parts of our economy over the long term. Betting that AI will change the world is an entirely reasonable position. But betting your entire balance sheet that the current price tag makes economic sense, that might just be the largest financial bubble ever inflated.